Hi, I'm Simon Roderick from Fram Search, and I'm delighted to be joined today by Sandy Wilson from Northtree. Sandy, how are you?
Very well, thank you, Simon. Very well, yourself?
Not too bad. As you know, I'm recovering from a little bit of flu, so still a little bit coffee. Had a bit of a bonkers Christmas, which I won't go into now, but apart from that, I'm very good. How's your Christmas?
Yeah, very good. Quiet, family, terrible weather, usual, really.
Sandy, let's get straight into it. There's lots I want to talk to you about today. Would you first and foremost please tell me about your firm, Northtree?
Yeah, of course. Thank you. So I suppose we're an asset manager of UK real estate. The business strategy really is to run sort of successive closed-ended and open-ended funds, ultimately, and co-investment vehicles, all investing in sort of UK property. And the key really, they're launched at points in the cycle where we believe the property is cyclically cheap, like now, and we can achieve sort of outsized returns. So we've got our first fund, or our current fund, I should say, is focused on sort of smaller last mile logistics assets, urban industrials, target locations in sort of large towns and cities, or locations that service those. That strategy is one of more active asset management, targeting higher returns. But then we also have a partnership with a large private bank where we're more focused on less management intensive assets, but really more with longer leases where there's the ability to distribute sort of relatively high income yields. So the sort of two complement each other.
And I suspect that the impact of the pandemic and the changes to how we live, obviously interest rates and everything else. This is a part of the economy I think that people are particularly interested in, an asset class that people are particularly interested in, and there's a lot of moving parts. So I really look forward to getting your thoughts.
Yeah.
Sandy, before you set up Northtree, you must have had an interesting career beforehand. What's your background?
Well, I did the sort of, to get into property, I did the sort of standard surveying degree, in land economy, which is really a sort of general surveying degree. And then I started with a brokerage in Glasgow, which buying and selling commercial property investments. After a couple of years there, I transferred down to London with them. And then 2 years after that, I went client side. To work with a company at the time called Threadneedle Asset Management, latterly known as Columbia Threadneedle or CTI. The Northtree team really is a lift out from CTI, and I worked at CTI with Nathan and Chris for over 15 years there. And really, we didn't want to reinvent the wheel. It's, at CTI, we're running both open and closed-ended funds. We fortunately managed to build up a strong track record, which enabled us really to leave and set up our own business. Something we had, independently coveted to do for a long time.
So that typical kind of route of larger firm wants to try something a bit more entrepreneurial, perhaps a bit more nimble, and so hence setting up Northtree, which is a really interesting career journey for people that I talk to and work with. So 2022, 2023 is a very different rates environment, perhaps than many of us have been used to for an awfully long time. And I suspect that real estate is one of the areas that's more impacted or affected by rates. In the higher interest rate world that we're in, how's the investment thesis for real estate changed for clients?
Yeah, I mean, it is an interesting question, I suppose. I mean, since the aftermath of the GFC, so sort of 2009, 10, and the sort of decade-long ultra low rates that followed, real estate delivered income. In a world starved of yield, property provided that yield. But that's all changed now. Cash itself's a viable investment class, where yields of around 5%, maybe below 5 now, can be achieved. It's an attractive, risk-free return. I think what else has changed, real estate debt is now very popular, as a subsector for many investors, and for good reason. Investors can achieve high single digit or low double digit returns, lending on conservative loan to values. So I suppose what that does mean on a risk-adjusted basis, equity investors in real estate should expect or will expect anything between 10+% return for, and this is as a total return, not just income, for more core type investments, up to 20% plus for value add and distressed. So really it's changed the bar, whereas the bar was 0 rates, now risk free's 4+. So risk needs to move up accordingly.
And are you seeing, very different performance in the subsectors of real estate? Because obviously it's an enormous world. So I think when we talk about property, we talk about real estate. We're all perhaps thinking of slightly different things. But are you seeing those subsector variances at all?
Yeah, massively. But I think interesting. I mean, one would imagine that commercial property values should be driven by the underlying fundamentals, i.e. the occupational demand, supply, etc. But really the biggest driver is liquidity and liquidity into sectors. So and rates, interest rates. So perversely, what we saw was in the last sort of 18 months as interest rates spiked out, it was the lowest yielding and notionally lower risk assets that were impacted hardest, because ultimately they were the most sensitive to the cost of borrowing or low rates. So it's didn't say, I'm not saying that you wanted to be in the higher risk assets because they also were impacted, but there weren't any safe harbors, let's say. I
Slightly
think
counterintuitive to an extent.
Yeah, exactly. And but that is, ultimately what we just talked about in the last question. It's the rebasing of the risk-free rate. So, but it was those the heaviest bought assets, i.e. the primest, most core assets, lowest yielding, were impacted significantly. Because of course, if you move from a 3 to a 3% yield to a 6% yield, that's a 50% fall in value. Whereas if you move from a 5 to a 7, it's less than 50%. So the impact is felt greater the lower the yield was.
Yeah, that's really interesting. And in terms of what you guys do, obviously, you're adjusting, or you've got your core focus. How are you trying to optimize returns in this sort of slightly higher inflation, higher interest rate world? Are the things that asset managers are doing to perhaps increase performance that perhaps they wouldn't have done before?
Yeah, I mean, it's not a simple question to answer that. I think, and ultimately it depends on an investor's appetite for risk. I think most investors like us, are really focused on buying cash today with the intention of debt financing later in the year, when many believe that rates will be lower. In actual fact, over the last 6 weeks, really just a couple of weeks before Christmas, bond yields did come down, and actually, so we're seeing the cost of borrowing today versus what it was 2 months ago is probably, 75 basis points cheaper. That, how long that will remain is up for debate. But so I think a lot of people are, because there's, if the problem with financing with expensive debt, or where the cost of debt was previously, it was maybe 7% plus. It's now maybe 6.5% plus. So unless your property's yielding over 7 day one, you'll be deficit financing, and most investors don't want to do that. Talking about risk appetite, you could of course go for higher yield and invest in the office sector, where there are some very high yields achievable, but there are also a load of banana skins out there, and many banks are overexposed to that sector and not really keen to lend new money into it. But fundamentally, higher inflation has led to higher interest rates, which has fed into declining property values. Therefore, I suppose in simplistic terms, buying now or buying over the next 18 months in a relatively high interest rate environment, it should set you in a strong position for capital growth if and when rates fall.
Yeah, which at some point we all know that they will. But a couple of points that you've raised that I think are really interesting. Firstly, we've seen a lot of clients, cash becoming an asset class is something that people aren't used to, and that's had a really big impact on people's businesses. But you mentioned about the office sector. Obviously, I'm very interested in that because that kind of ties in with working from home, hybrid working, which is a huge theme for our clients and candidates. There's been a little bit of tension, I think, over the last 12 months as there has been a return to offices. But how much of an impact has hybrid or remote working had on commercial property? And how do you see the long-term trends of hybrid working and its relation to the office sector?
Yeah, I mean, I think it's still too early to fully understand the impact, but there's certainly a few trends have emerged or are emerging. Firstly, tenants they're definitely trading down on size and up on quality. As the labour market is tight and there's a war for talent out there. So if a company wants to attract the best talent and you want them to commute to an office, even if it is only for 3 days a week, the office needs to be of high quality. And I think we're seeing evidence of this in, record rents achieved of over £200 a square foot for the best quality space in London's West End. Also, many landlords argue that whether a tenant uses a space 3 days a week or 5 days a week, it doesn't really matter, as they still all want to be in on a Wednesday and a Thursday, so they'll need the same amount of space. And I think that does make sense from a sort of a logic perspective. However, anecdotally, we're definitely seeing that most occupiers renewing office leases or moving to alternative offices, they are reducing the footprint. So it's difficult, or it's too early to exactly tell on that. But I suppose, to answer your question on long-term trends, it feels like the lasting legacy, or one of the lasting legacies, will be most people who work from home on a Friday. I think that's taken as read now, isn't it? Having been in London for a few Fridays over the last couple of months, it's amazing how quiet it is. But as a consequence of that, it's difficult to get a restaurant reservation on a Wednesday or a Thursday night because it's packed. So I think people are just cramming it into a shorter period. I think with regard to impact on values, from an investor's perspective, pricing and investor demand is driven by sentiment, and sentiment towards offices as a subsector is at an all-time low or approaching it. I think this is, in the UK, certainly it's exacerbated by the US and the very high vacancy rates that we're seeing in certain submarkets like Manhattan or San Francisco or whatever, who have their own issues. And I think here in the UK, there's very few buyers of offices, especially, any offices that don't have an alternative use play or a long lease to a strong covenant.
It's interesting. I mean, I think I agree with you on the long-term trends of hybrid working. Using your expression, if there's a lasting legacy, of the pandemic, I think it is going to be this hybrid working. It seems to me you're right. Tuesday, Wednesday, Thursdays, these sort of pulse days in central London where activity picks up and then it drops off. But yeah, it's very interesting around. You've got, from what I understand, lower quality offices are really struggling, and then you've got a few kind of prime central London offices setting record rates, and it seems that there's almost like a two-speed marketplace in effect. But I guess there's a lot of bank exposure to this asset class.
Yeah, I think the prime works, because you're achieving record rents. However, that is probably only 5% of the market, max
Right.
10. The issue you've got with the rest of the market is, for instance, your M25 office market, where rents have stagnated. If anything, there's minimal demand, so rents are lowish. If you buy a building that requires capital expenditure, and the cost of that capital expenditure is double what it was 7-8 years ago, it's not financially viable to buy something, refurbish it, and let it. A lot of these tertiary, let's say, and some what were good secondary are becoming tertiary, in the sense that the value of an unrefurbished office could be less than zero.
Wow.
And that's the terrifying thing, and that's where there are a number of skeletons in closets that will be coming out over the next 12, 24 months as some financing, comes up for renewal, where banks banks will just not refinance a mortgage in an office unless you are going to get it to an EPC or B. And this is with regard to the ESG components. That's, there are regulatory restrictions and changes coming into play where it has to be a B at a point in time. And if you don't get it to that, it'll be illegal to lease it. So it's worth nothing. So you have to sort of make sure your underwrite includes that capex. And again, it's if you're buying off, at the moment there are a number of distressed sellers out there. Why are you going to buy a risk asset, which is say an office that needs a refurbishment? You've got refurbishment risk, you've got leasing risk, you've got exit risk, etc. Further down the line. Why are you going to buy that when you can buy an income producing asset at an attractive price?
Absolutely. No, there's lots of questions, and as you said earlier on, lots of banana skins, I think, for people to slip on. And talking about the ESG angle, for you, somebody who's been in the asset management industry for a long time, how important is it to look at investments through that ESG lens for institutional investors?
Yeah, I mean, I think unless you've been under a rock for a few years, everyone knows it's extremely important. It used to be a sort of nice to have, and now it's an essential consideration, and not just for institutional investors, actually, for all well-informed investors. I think for property investors dealing with the E and ESGI, the environmental considerations, it's pretty simple. There's current legislation I was just mentioning that requires any landlord to ensure that the property meets a certain EPC rating of E. It goes A to G. So if you're an F or a G right now, you cannot lease the property legally. So it has to be an E. This is supposed to, and it's not set in stone, but the guidance says that this will rise to a minimum requirement of C in 2027 and B by 2030. So as to my point, if you're buying, any asset you buy now, you must be confident you can viably get it to a B within your hold period, or you're going to have a problem selling it. Whereas before it was a nice to have, now it's essential purely for liquidity reasons, if nothing else.
So the whole focus and the rationale has become so embedded into that investment process, as opposed to just a box ticking exercise that maybe it was, for argument's sake, 10 years ago.
Yeah, which is great. And that was the intention of the legislation, I suppose. So it, in a rare occasion, it's worked. Yeah.
Yeah, absolutely.
But what it has unfortunately led to is leading to a number of stranded assets, what are called stranded assets, where it is not economically viable to get them to that level of B. So you might as well knock it down. So there are instances where, an office building could be worth more, or that the site that it sits on is worth more without the building there than it is with the building there, which is crazy, but that's the way it is.
And does that dovetail nicely into the UK's housing shortage then? It's, because I've heard that, I mean, I'm in any way not a builder or anything like that. I'm not technically an issue, but I have heard it's quite difficult to transition offices into residential. But if you were to level the office and to build that site and turn it to residential, is that something you think we might see more of because of the housing crisis?
Yeah, definitely. And what we have seen up to now as well is there's a number of, depending on the location, obviously, there are a number of buildings it's better to knock them down and put industrials on them. It's worth more as industrial. Or indeed, it's worth more as open storage, which is effectively just flatten it and use it as a storage site. The beauty of that is you don't have empty rates to pay if, while you're leasing it up, etc. And there's minimal capex. So yeah, I think that the repurposing will happen, but it won't necessarily be conversion of those buildings. In some cases it will, but in a lot of cases it will just be knock them down.
And is that Sandy playing into, again, a sort of pandemic theme, post-pandemic theme of accelerated online shopping and therefore more logistics and infrastructure? And obviously that's a longer term trend, not just a pandemic. Is that why things like open storage and industrial is more valuable? Is that one of the themes?
Yeah, and that's been a theme that started really 7-8 years ago. Certainly the industrial space and the increased online spend, which was massively spiked with the pandemic, and it's come back down to settle at a higher level with regard to percentage of online spend. The logistics supply chain in the UK is actually one of the most advanced in the world because we're quite a tight we're a tight market and a reasonably sophisticated market. However, it's still nowhere near maturity. So there are a number of the operators that do still want to and need to improve their supply chain. So there is still strong activity. Without going into sort of too much detail and boring you, the logistics space is not just one subsector. It depends on the size of the units as well. So, the large sort of Death Stars, if you like, the Amazon warehouse that are 1 million square feet, that the supply side is very different for them than it is for the sort of sub 100,000 square feet smaller units that say that we're focused on. And I think the focus for us is not because it's binary, it's logistics or nothing. There's a number of competing land uses for those kind of urban and semi-urban locations where it can go to residential, it can go to open storage. The occupiers for the industrial units is very diverse. You have logistics guys, but you just have people that want to store stuff. You've got some manufacturing, you've got dark kitchens, there's a very diverse occupier base. Whereas if you've got 1 million square foot shed, let's Amazon, and they move out, like, I don't know who else is going to move into that. So the risk profile is very different.
And that's why I love doing these conversations, because I'm learning as we're going along. You think about these problems and then you think, oh, maybe you could do that. But actually, when you talk to people who are specialists in the field, you start to realize actually how complex some of these challenges are and the dynamics and how interesting they are. So now I did tell you a little bit of a lie, because I said to you, okay, let's have a chat, and the interview will be about 20 minutes and we're coming up to nearly half an hour. So time flies when you're having fun. If you were going to sort of pick up 2 or 3 themes, either good or bad, over the next 5 years, what would you, in summary, sort of say that they are the key drivers for the industry?
I think at a more granular level, I think as an opportunity, we're still very bullish in these small, last mile logistics and urban industrials. Supply is tight, competing land uses, very diverse occupier base, I said, and rental growth has slowed, but we're still seeing tailwinds there. So that's, for us, that's an opportunity. I think as a challenge, interest rates staying higher for longer than anticipated, that will create significantly more loan defaults and put pressure on values. I think that what's amazed me is that with the cost of living crisis, it doesn't seem to have fed into retail sales. And it's amazing how resilient these, retail sales have been, considering the significant inflation that we've all experienced, particularly in energy and food bills, and the impact that must have to disposable income. So that it feels like there could be a sting in the tail there. I think homelessness, as in the resi side you were talking about, and general lack of housing. We're working a project at the moment, to convert effectively hundreds of HMO beds from the private sector into the public sector and provide beds for homeless people, in conjunction with local authority demand, etc. It's a massive problem, and there doesn't seem to be any sort of long-term plan to address it. And I think, higher interest rates have led to more people renting, and the pressure on rents increasing is only exacerbating that problem. So I think that those are definitely challenges, and I'm not saying we've got a solution for it. I'm just saying, they're the challenges.
Yeah.
And then I think to try and finish on a brighter note, I think as a general opportunity for UK real estate, it feels, from a very high level, it feels like we're at or we're close to a peak in the interest rate cycle. And at the same time, we've got a number of mandated vendors, either funds having to sell to meet redemptions, or, leveraged buyers coming off a low fixed rate. So, and we invest in what is a cyclical asset class. So I think on the basis of those 2 points, it feels like 2024 and maybe 25 will be the right point in the cycle to invest.
Yeah, I can see the logic very clearly. Well, thank you for your time. It's been really great. If people want to get in touch with you, how do they do that?
Yeah, I think it's when it's sw@northtreeim.com, or you can go on the Northtree IM website and get into our contact details there.
Well, thank you for your time, and look forward to catching up soon for a beer or something.
Great. Thanks, Simon. Take care.
Take care. Cheers. Bye-bye.
Cheers. Bye-bye.